Welcome to this Executive Explainer. Today, we're cutting right through the political theater to examine the strict mathematical realities of the U.S. sovereign debt crisis and, more importantly, its systemic risks. We're going to be looking at this specifically through the lens of a corporate executive who is evaluating a severely distressed balance sheet. Here's our roadmap for today. We'll start with the balance sheet crisis, move into warning signs and market signals, evaluate the macro strategic exits, discuss the operational consumer headwinds, and finally, lay out a strategic asset allocation playbook. Let's dive right into Section 1, the balance sheet crisis. We've officially breached $38.9 trillion in national debt. To put that massive figure into a micro perspective, the average household share is now $288,000. Think about that. That's literally more than the median home price in 30 states. And we're currently running a perpetual $2 trillion annual deficit. I mean, let's be honest. If your corporate P&L looked like this, your board would have replaced you yesterday. But the headline number isn't even the scariest part. Take a look at the inflection point we hit in fiscal year 2025. The $970 billion required just to service our debt actually surpassed our entire national defense budget. That is strictly interest. It's essentially rent on money already spent without retiring a single penny of principal. We're now paying more to bondholders than we pay for every aircraft carrier, soldier, and missile combined. So what does this actually mean? Well, it brings us to Ferguson's Law, named after historian Niall Ferguson, who looked at about 500 years of data. His law shows us that historically, every great empire that crossed this specific financial threshold, spending more on debt service than defense, either lost its global status or was forced to dismantle itself. We're talking Habsburg Spain, Bourbon France, the Ottoman Empire, post-World War I Britain. The United States quietly crossed this historical point of no return in 2024. Moving right along to Section 2, warning signs and market signals. You know, a crisis like this doesn't just happen overnight. It's more like a slow-motion fuse. Think back to Moody's unprecedented downgrade in early 2025, stripping the AAA rating we'd held since 1919. Then we had legislative actions adding trillions to the deficit. After that, weak debt auctions where buyers demanded steep discounts, China's holdings dropping to 2008 lows, and 30-year yields spiking to 5.19% by May 2026. Individually, sure, these are just headlines, but together, they are a systemic alert flashing bright red. And compounding all of this is a dramatic shift in exactly who owns this debt. Back in 2008, foreign holdings made up about half. Today, they've plummeted to less than a third. That leaves domestic entities, our own banks, money market funds, and pensions, to absorb the growing burden. As an executive, treat this like a severe vulnerability in your supply chain. Our foreign buyers are stepping away, and we're increasingly having to finance ourselves. So when organic demand dries up, what does a government do? Simple. It engineers a captive market. Legislation like the Genius Act legally requires crypto stablecoins to hold short-term treasuries. That effectively forces a captive market that's expected to hit $3 trillion by 2030. It's basically passing a law to invent a brand new buyer for your own debt. Meanwhile, the smartest money in the world has been quietly voting on the future of the dollar. We saw gold driven past $5,000 an ounce in January 2026, with central banks buying at the fastest pace in 50 years. Look, when institutional money chooses a shiny rock that pays absolutely zero interest over a treasury bond paying 5%, that is a massive vote of no confidence. Okay, Section 3, evaluating macro-strategic exits. As corporate leaders, we have to look at the realistic pathways out of this balance sheet trap. How does this resolve mathematically? Well, when we evaluate the 4 potential sovereign exits, 3 of them are firmly closed. Austerity? Mathematically locked. It would require permanently cutting the equivalent of the entire Pentagon budget. Growth? Locked. We're projected to grow at 1.6%, well below the 3% needed to outrun this snowball. Default? Locked by mutual self-preservation, because it would instantly vaporize the dollar's reserve status. So what's left? That leaves only inflation, or financial repression, as the definitive, unlocked path forward. And Ray Dalio explicitly confirms this exact trajectory. He's forecasting a debt-induced crisis within 3 years, where the dollar's purchasing power is systematically reduced just to make the math work. The underlying strategy is to pay off $38 trillion in nominal terms with dollars that simply buy less stuff. Make no mistake, this is effectively a stealth tax on your corporate cash reserves, intentionally designed to keep rates artificially below inflation over decades. Which brings us to Section 4, Operational Consumer Headwinds. Because listen, this macro reality isn't just academic theory, it translates directly into operational headwinds. For a standard family, persistently high rates around 6.5% mean paying over $10,200 in additional interest annually on a median home, compared to that cheap debt era back in 2021. That is $1/3 in extra interest over a 30-year loan. Think about the ripple effect. That is capital directly removed from discretionary consumer spending. It's over $10,000 less that they are spending on your company's products and services. And it gets tougher. The raw math guarantees that both the Social Security and Medicare hospital insurance trust funds are facing depletion by 2033. Barring some kind of drastic legislative intervention, we're looking at a forced 23% benefit cut. Alongside the inflation we just talked about, this just compounds the whole problem, creating an environment of higher taxes, lower real returns, and continuously leaking purchasing power for your consumers. Finally, Section 5, Strategic Asset Allocation Playbook. Given this unavoidable trajectory, how exactly should you be positioning your corporate treasury? Well, look at the heavyweights. People like Ray Dalio, Stanley Druckenmiller, and Warren Buffett are fortifying their positions with massive cash reserves, significant gold allocations, and strategic shorts against long-dated treasury bonds. The absolute most experienced minds in finance are aggressively positioning for a storm. They are actively seeking insurance against the dollar. So here's a prudent, defensive playbook for your corporation. Step 1, hold 10 to 15% in gold, strictly as insurance. Step 2, shift your capital to real assets and productive businesses that have strong pricing power. Step 3, avoid 30-year lock-ins entirely. You want to stick to the 5 to 7-year treasury curve. And lastly, utilize I-bonds and TIPS for actual inflation protection. The bottom line, the era of cheap money and free lunches is mathematically over. We are entering a very specific era of deliberate, slow-grinding financial repression, which leaves us with one final, absolutely critical question as you evaluate your corporate and personal strategies. Is your portfolio properly positioned for the slow, inevitable grind of financial repression?